Hello, I'm Garrison Foster, BBMC Mortgage. I was just hanging out here, thought maybe I'd jump on and we'd do a little discussion about VA mortgage myths. More than just the myths, I always find when I cover something, a common myth like you can only have one VA loan. Well, you can have more than one VA loan, but where does that myth come from? Why does it exist? Why do so many people think that you can only have one VA loan? Well, the reality of it is, as part of the Servicemen's Reinvestment Act of 1944, it was a one-time use. So at a time, it was a one-time use. Well, now there is not that restriction. And so not only can you have more than one VA loan, you can have more than one VA loan at any given time. You could have 2 to 3 VA loans simultaneously. Now, a VA loan is for your primary residence, so how would that work? I purchase a home, and I'm in that home for, let's say, a year. And then I decide that I'm going to get married and I need a larger home for my family. Great. I can move out of the home that I'm currently in, and then I can purchase another house. I can leave the VA loan on my first residence, and now it's a rental property, and now I have 2 VA loans, my primary residence and my old rental property. And you can continue to do that as long as you have remaining entitlement. And by the way, this is interactive. If you'd like to reach out to me with a question, I'm under the assumption that I will actually be able to read this question, and then I'll be able to answer that question. Exactly. Hey, Jill, how you been? Oh, it's kind of funny. I just see you there. This is a new experience for me, just if you're wondering. So I'm actually kind of excited about it. Let's talk about another myth. Let's talk about another myth, like, for example, you cannot buy a home over $417,000, right? That's one of the most common myths out there, is you cannot buy above the county limit. The FHA set county limits, like, for example, $271,000 is the county limit in Johnson County, Kansas, right? Well, you cannot do an FHA loan for greater than that $271,000, right? Well, the VA does not work that way. So the VA loan limit only reflects the amount that the VA is going to insure. The basis of a VA loan is a 25% insurance policy, right? So if they're insuring 25% of up to $417,000, great. You can actually do a loan of greater than $417,000, but the veteran themselves would need to cover that 25%. An example would be a $517,000 purchase price in a $417,000 county. That's $100,000 over the county limit. Veteran just has to put $25,000 down, 25% of the $100,000 over the limit. So that's one of the other myths that is very, very common, more on the realtor side than the loan officer side. Most loan officers do understand and know that you can go above the limit, but a lot of realtors are unfamiliar. It's really not their fault. It can be very difficult to even look up a guideline with the VA. I had that question a lot. That's a good question. So one of the questions I get a lot is, how do I find out a particular rule for the VA? Well, here's how the VA work, right? The VA is really more like an insurance company than a lender, right? So they're insuring a portion of the loan. The guarantee, the VA guarantee people reference, is that 25% insurance policy. Look at me, I'm talking in quotes. It's that 25% insurance policy, right? And so why are there so many variances to the VA rules, or why is it so difficult to find out, what is the waiting time frame after a short sale, right? Well, the reality of it is the VA set minimum standards in order to get VA insurance, but it's up to the banks, and they task the banks with assessing risk and lending money. So if it has to do with risk assessment, most of the time it is the bank's responsibility to do that. So why is it so difficult to come up with the criteria for a VA loan? Well, because each bank starts from scratch and they assess risk differently. You have Bank A that assesses risk in one particular way, and Bank B does it different, meaning there's actually 2 different VA loans when you're looking at 2 different banks. Now multiply that by several thousand. There are actually several thousand different types of VA loans because each bank has their own definition. Bank A may say, well, you had a short sale, you didn't honor your contract, so you have to wait for the foreclosure time frame because it's just like a foreclosure. Well, Bank B would say, well, you know what, you did short sell your home, but we were made whole by the VA, we didn't lose any money, so it's perfectly acceptable for you to get another VA loan the day after your short sale. So when you're being told, you don't qualify for a VA loan, in the back of your mind, you really have to think, I don't qualify for a VA loan here. I might qualify for a VA loan there. So if you're being turned down or turned away or discouraged from using your VA benefits, the answer might not be another product. The answer might be another bank. The answer might be another lender who has different guidelines than you have. And so that's an important thing to think about. One of the other myths is that there is a VA loan, they're restrictive, they're difficult to use. Well, the reality of it is that's the lender as well, right? So perhaps it's not the VA program, perhaps it's the lender or the loan officer or the realtor you're working with. If you're ever being discouraged in any way from using your benefits, that's the red flag. Typically, if you've served the right amount of time, you are going to qualify for a VA loan. What are called or commonly referred to as overlays are the bank's guidelines. I don't really like the term overlay because it's not really an overlay. They're creating their guidelines from scratch, so there's nothing to overlay. But if this bank's guidelines are not the same as this bank's guidelines, which bank do you go to, right? Leads me to a nice point, right? If you're going with a primary lender, a large bank, and I don't want to name any of these institutions, but a large primary lender, then you're dealing with one bank's guidelines, right? If you're going with what's called a correspondent lender, a bank that represents other banks, like BBMC Mortgage, for example. We represent dozens of banks. So we're able to piggyback off the guidelines of all these banks. And so perhaps Bank 1, Bank 2, Bank 22 doesn't fit your guidelines, but maybe Bank 23 does. So either working with or looking at the guidelines with 27 banks on your own, or working with a correspondent lender that represents dozens of banks, that's kind of the way to go. So I hope this is semi-informative. I have just a couple of seconds left. If anybody else has a question, I can answer that real quick. If not, I appreciate your time, and I hope that I will be doing this again for you sometime soon. You guys will have a great day.